You got to be flipping my flapjacks. For the first time in over 4 years, the Federal Reserve is lowering interest rates. Jerome Powell and the Fed, they're lowering interest rates. Since the rate hike cycle, that started over 2.5 years ago. And now we're finally cutting the point in time everybody's been waiting for, 50 basis points of cuts, which is obviously what I had suggested they do for quite some time now. They went ahead and made that move here today. They also signaled that they're going to be reducing interest rates quite considerably over the next year or two here, okay? Now, the NASDAQ, before the 50 basis point cut, it was in a little rougher territory. People were a little uncertain, and next thing you know, the 50 basis point cut came, and the NASDAQ skyrocketed. But by the end of the trading day, it finished right back where it was prior, right? Meanwhile, we had things like this going on. Treasury yields were going up. Everybody basically had banked that treasury yields would be going down, especially on a 50 basis point move. And yet you looked out there, the 30-year, 10-year, 7-year, 5-year, 3-year, 2-year treasuries, all were actually green here today. Mortgage rates could be going back up now at this point in time. And the reason being, when you look at the 10-year treasury, since that's going up, there's a potential that mortgage rates are going to go up now, which is completely mind-blowing because everybody had banked that mortgage rates were going down, right? That is pretty shocking in itself. If you look at this, this is nail. This is a 3x, basically, bull leverage on home builders. Before the 50 basis point cut, this baby was, around 160, 162. And then after the 50 basis point cut, it went straight up to 172. A lot of people that were playing nail. They made some money there in the short term, right? And then where to go? It went right back to where it was prior. Absolutely amazing, right? GSG, a lot of people had banked, if they cut 50 basis points, just wait to see commodities. I heard a lot of folks, a lot of experienced folks in the market said, commodities, just wait. And here we are. GSG went down after the 50 basis point cut came, right? Crude oil went down about 3%. It's like, what is going on here, right? Meanwhile, the Russell skyrocketed after that 50 basis point announcement came and then went straight back down. Put to call ratio, given that a 50 basis point cut, you would have thought more people would be buying call options out there. The Fed's cutting more than expected. Great news. That's what a lot of people would assume. Meanwhile, no. People are actually out there buying puts today, right? So this is really, really fascinating. So what I want to do in this video for you guys here today is make sense of all this, okay? We're also going to talk about some hedges I'm looking at now with the Fed the Fed's going to be cutting pretty aggressively over this next year or two. What am I looking at? There's some very attractive hedge plays that I'll go through in this video here today and explain those. Basically ways I can make money on downside as well. And then we'll talk about where to actually buy, because there's a tremendous opportunity in terms of buying stocks out there for a specific segment that I'll run through in this video as well. I think that's very important also, okay? All I ask from you guys, smash that thumbs up button and make sure you're subscribed here to the channel. We've got a new 1,700 subscribers on the channel. Appreciate you all, 736,000 plus subscribers, so we're on the way to a 737. I appreciate y'all being here as always, okay? Alrighty, let's get into this. So, where I'm going to start here, Fed lowers down to 4.75 to 5% Fed funds rate, right? This is a right move in my personal opinion. The right move. As I told you guys before, we basically have Fed funds rate 5.25 to 5.5. We have a CPI of 2.5, which that CPI is actually much lower in reality. Truflation has us in the ones right now. So we have this massive divergence between where the Fed funds rate's at and essentially where inflation's at, right? You have a lot of room to lower rates. I mean, the Fed, in theory, could have lowered 250 to 300 basis points today if they wanted. Obviously, the Fed's not going to do that. They're going to try to go in a more deliberate fashion down in a more, let's call it orderly way. They're not just going to lower interest rates 250 basis points. But in theory, they could have, right? They could have lowered down to like a 2.5, given that CPI is at 2.5. They could have lowered down to like a 3, given CPI is at 2.5 right now. So they could have made that move. They didn't make that move, right? Now, the important thing to understand about this, right, is we don't want another 2022. In 2022, the Fed was way late to the game in terms of raising interest rates. And then when they started raising interest rates, they went 25 basis points. Huge mistake by them. You got to get the moral of the story is the Fed has two problems they have to worry about all the time. They always have to worry about inflation, right, price stability, and they always have to worry about the jobs market, what's going on with employment. So in 2022, the issue was inflation, which means they should have got out there very aggressively, raised interest rates, started raising interest rates at the end of 2021. Technically, they should have, right? And then they should have kept raising at probably a 50 basis point clip. They probably would have never had to go to 75 basis points. And guess what? They might not even had to have gone as high as they ended up going in regards to Fed funds rate, which was by far and away the highest we've had in several decades. They wouldn't have had to do that if they just got out there, move. But instead, what did they do? They lagged. They lagged big time. It took them forever to start raising rates. And then when they did it to 25 basis points, that's not going to do anything, man. And so here, the Fed's realizing we got to get moving here. If we don't do this, essentially, we're risking a major recession. If we do not get out there and start lowering interest rates considerably, this is moving in a good, steady direction. You do 50s, that's not panic. 75 basis points or more is panic. 2022, the Fed had to get into panic. Why? Because they were late to the game. They waited way too long. Do you want to see the Fed in panic again? If the Fed just goes 25 here at the beginning, then another 25, let's say in a few months, right? And next thing you know, economic data starts coming in really weak, the Fed's going to start panicking. Next thing you know, they're going to up it to 50. Next thing you know, they're going to up it to 75 basis points of cuts. And then the market's going to be in full-blown panic mode. You're going to have everything crashing left and right. You're going to have CEOs get freaked out. You're going to have firing left and right. You're going to have the unemployment rate skyrocketing. It's going to be a whole mess, all because the Fed went too late and too slow, right? You got to get moving on these things, whichever way you're going to go. And so the Federal Reserve made the right move here today. No doubt about that. You go 25, it's going to look bad once a recession ends up showing up, right? Now, additionally, this is a dot plot that the Fed puts out, right? Now, you can kind of trust the dot plot for like a month or two, but honestly, anything longer than that, don't have faith in it, because these Fed officials move all around depending upon how data's coming, depending upon how the markets react, and all sorts of things, right? But basically, we're almost guaranteed to have another 25 to 50 basis points of cuts in November, okay? So it is something to kind of take into account here. I would say it's basically a guarantee. Looking at the dot plot, most of Fed officials are right around 4.5%. Some are a little under 4.5%. Some are a little above 4.5%. And right now we're at 4.75 to 5 on Fed funds rate. So which means we got basically 25 to 50 guaranteed coming in November, okay? Which will leave us somewhere roughly around 4.5% Fed funds rate when we exit this year in 2024, right? Which is only a few months from now. Now, as far as next year goes, basically where the Fed officials have us is somewhere around 3.25 roughly, which means there's going to likely be another 100 or more than 100 basis points of cuts coming in 2025, okay? Now, don't have too much faith in that, because I'm telling you, the Fed can move these things around massively, even in a 3-month span, never mind 6 months out, 12 months out, 15 months out. Oh my gosh, can they move these things around? So I would say this is the bare minimum. That's how I would look at this. This is the bare minimum they're going to be cutting in 2025, would be 100 basis points. That's bare minimum. But don't be surprised if they end up cutting like 200 basis points in 2025 and getting us into the twos when it comes to their Fed funds rate. And the reason being is if they saw inflation is not an issue. We know that, right? We're not going to get inflation in housing. We're getting more and more inventory hitting, right? More and more apartments are obviously being built that are coming online right now. And I talked to too many people in too many different markets. I have real estate properties in several different markets. I'm not seeing anything as far as housing goes that's really going to cause any sort of major inflation there. Commodities are down substantially over the past year, so that's not going to really give us any problems as far as that go. Companies don't really have great pricing power right now, just to be quite frank. So you're not going to likely see any major inflation. So inflation's completely off the table for at least a year now at this point in time, right? But if you see the employment market weaken, guess what the Fed's going to do? They're going to have to come in with several 50 basis point cuts. So you could see this 50, then maybe another 50 in November potentially, and then you could see something like 4 50 basis point cuts, one in the first quarter, second quarter, third quarter, and fourth quarter next year, right? Assuming inflation is not an issue, which it's not going to be, and assuming the employment market doesn't look that great. If employment looks great, let's say we have an unemployment rate under 4.5%, I believe the Fed will take it down to 25 basis point cuts, right? That's what will likely happen if we can stay under 4.5% in regards to the unemployment rate. Now, this freaks people out, and I understand. Like it's ominous, right? Because we've drawn a lot of parallels back to the great financial crisis, right? A lot of parallels. And this is probably the freakiest, scariest one of all of them, right? The Fed cut interest rates, cut Fed funds rate by 50 basis points September 18th, 2007. And here it is, September 18th, 2024, and they just cut 50 basis points. That's freaky, right? Very freaky. But I would say this should be something that gives people a little bit more confidence. The unemployment rate's still relatively low compared to 2007. You know, with 4.7% then, it's 4.2%. So the Fed likely in 07, they started playing the game a little too late in terms of the cuts, and the dominoes fell too fast, right? This is one of those situations you look out there and you're like, they might be able to stop the unemployment rate somewhere in the kind of the 5s or the 6s, which would be ideal. Great financial crisis was ugly. We went all the way up to 9, 10% unemployment rate. That was really, really ugly. Since they're getting out here earlier in the cycle, this could give you a better chance at, let's call it a soft or a medium landing, rather than almost guaranteeing a hard landing like obviously they had in 07. So that's a little food for thought in regards to that, right? Now, the important thing to remember, because you see the Fed cutting rates here today, a lot of people get this assumption of this feeling that like this is going to massively help out the economy tomorrow, today, right now, okay? Listen, these cuts the Fed's doing right now, okay, the cut they just did today, this will be felt in the actual underlying economy for consumers, for businesses, and it will be felt 1 to 3 years from now, okay? This isn't felt right now. This isn't like you go to the restaurant and you're hungry and you order the burger from McDonald's and they bring it to you in 2 minutes and you eat it right away, okay? This is like going to a fine dining restaurant where it takes a while to prepare the whole meal. That's what this is like, okay? So don't think this magically fixes, if you feel like the economy is not in the best place, just understand it's going to be likely even in a worse place 6 or 12 months from now because the Fed lags. And it's not just like this fixes everything. No different than when the Federal Reserve was raising interest rates. It's not like that magically fixed inflation right away. If it would have, we would have seen inflation not be an issue, certainly in 2022. And yet inflation was still an issue all the way until really the beginning, the first half of 2024, way after the Fed started raising. So this is something you got to keep in mind out there is the lags are here. And it's just not enough people talk about the lags. I'm like, it's kind of important, right? So here's a way to look at this. The 2024 cuts we're getting, right? These will be felt in the underlying economy and the business community. These will be felt late 2025 to 2027, okay? So we got some time to play out here. The cuts they're going to be doing in 2025, which there's I would say, if I had to predict how much they're going to cut in 2025, I would say between 100 and 200 basis points. 100, the lowest I could see them cutting in 2025. 200, probably the most I see them cutting in 2025, unless it got insanely ugly for some reason or something like that, right? So these cuts in 2025 we're going to be getting, those will be felt in 2026 to 2028, okay? The next 12 months we have here, we're in no man's land, okay? The Fed raising rates and keeping rates so high for so long, that's going to continue to hit us for the next year, okay? And so that's the important thing to remember is now we're in this time period of no man's land where, that hiking cycle is going to continue to weigh on the economy. It's going to continue to kind of put pressure on us and kind of keep us down for the next year. And it's just something you have to factor in when you're kind of thinking about the economy, when you're thinking about businesses, when you're thinking about numbers and things like that. This stuff doesn't work like overnight. You wish it did, but it really doesn't. Okay, so that's just a little food for thought in regards to that. Now, there's one thing that will be felt really rapidly here, and it's not a good thing for us that have money in savings accounts, is I'd almost guarantee you there's going to be cuts coming in all savings account rates over the next 30 to 45 days. So if you have money in a high yield savings account, whether it's through an Ally or whether it's through, Marcus product at Goldman Sachs or any of the other ones, some of the regional banks, whatever, right? If you have money in a savings account and it's getting you 4 to 5% right now, which is where a lot of the higher yield online savings accounts have been getting you, you're almost guaranteed to see cuts in that amount of money over the next 30 to 45 days. You're likely going to receive an email to your inbox and it's going to say, hello, Johnny, we're lowering our rates to this. And don't be surprised if a few weeks after that you get another email that says, hello, Johnny. Hello, Samantha. We're lowering the yields again. Okay, so that's a little food for thought in regards to that. They're going to say they're going to be competitive, but once they all start lowering, they just one after another, because they can all get away with it, right? So now in regards to, are you going to get some, if you have credit card debt, which I hope most of you guys don't have any sort of major credit card debt, right? If you do have that, don't be surprised if you still have to pay really high rates in the short term. Unfortunately, it is what it is, right? The good side, they take that down right away, but the bad side, that takes a while. No different than when gas prices, if oil price shoots higher, gas stations are quick to move that price up. But then all of a sudden gas, a barrel of gasoline goes down, oil goes down considerably, and gas stations are really slow with moving those prices back down. I come from the gas station industry. I know what that's about, right? And so that's what happens in regards to this. Credit card rates, you're still going to be paying big numbers on those, but don't be surprised if your savings account rate drops a lot over this next 30, 45 days, which then you start saying, okay, what are people going to do? A lot of people have a lot of money in savings accounts. If their rates are going to go down, it's not like it's just going to go down for the next 30 to 45 days. If the Fed keeps lowering Fed funds rate, which they likely are for the next 1 to 2 years, it's going to keep going down. So then what do? So then you start to say, okay, I need yield. All of a sudden these savings accounts are starting to get 2%, 3%, right? So then you're going to look to treasuries. Well, here's the issue. Treasuries are starting to yield less and less and less. All these guys were yielding 5% not that long ago, like literally just 6-9 months ago. All these guys were 5% plus, 3 months, 6 month, 12 month, 2 year, 5 year, right? It was phenomenal. And they're going down and down and down and down and down. The 3 month now is down to 4.76. 6 months down to 4.5, the 12 months down to under 4, the 2 years down to 3.6, the 5 years down to 3.4, and keep in mind these will likely continue to go lower for the next 1 to 2 years. So you're suddenly going to be in a situation where people's savings account rates are going to get cut significantly over this next 12 to 24 months, and if you've been making money in treasuries, that substantial amount of money is going bye-bye as well, which is not going to be fun for people, because then people are like, what do I do? Where do I go? I need yield. I got money, I need yield. And I can't get in treasuries, I can't get in savings accounts. So you know what they're going to do? They're going to start going back into the good old dividend stocks. Dividend stocks have seen a massive sellout in regards to value in dividend stocks for really, it's been over 2 years. And the reason was the Fed raised interest rates so much. Next thing you know, you can start getting 4% on treasuries, 5% on treasury, 5.5. I remember it wasn't that long ago, it was probably in the past year, you were able to get over 5.5% on a treasury, right? And so people were like, why would I own dividend stocks when I could get 5.5% guaranteed from the government and treasuries? Numbers that we haven't seen in decades. Why would I do that? So people said, the hell with these dividend stocks. And they sold out, and it put the most selling pressure you've really seen on these value and dividend stocks. It put the most pressure on them we've honestly seen since the great financial crisis. I mean, historic drops. And many of these value and dividend stocks are trading at 4-year lows, 5-year lows, 7-year lows, 10-year lows, some at multi-decade lows right now. Because it was just a complete sellout of these stocks, because people are like, I'm going to get 5% at the bank. I get 5% at Ally. I get 5% in treasuries. I don't need you dividend stocks. But what we're going to see play out now, 2025 and 2026, a big move back into where? The dividend stocks. These same people that sold these stocks heavily in 2022, 2023, and into this year are going to come back like nobody's business in 25 and 26 and say, oh, dividend stocks, I missed you, because now we're not getting what we used to get over there in those savings accounts or treasuries. And the more the Fed moves rates down, the more the dividend stocks are going to become the play, and especially as a lot of these dividend stocks are still recovering from kind of the Rona cuts of dividends and those sorts of things. A lot of them still have a lot of room to raise their dividends. So what you're going to see now that these stock prices have fallen so much, and they're going to likely raise dividends, is they're going to command a bigger and bigger yield. So dividend stocks are yielding more and more. Meanwhile, guess what? These are yielding less and less, savings accounts and treasuries. So you're going to have a bigger and bigger move, and that's going to be a multi-year move. That's a 2-year move. So it's not like it's just like people are going to buy dividend stocks one day or 1 week. No, this is going to be for the next 2 years. The next 2 years, people are going to be moving money out of treasuries, moving money out of savings accounts, and they're going to be moving money into dividend stocks, and it's going to be a 2-year move. No different than it was a 2-year plus move in terms of the exodus of these dividend stocks and people leaving these, right? So a little food for thought in regards to that. Now, if you look at what I'm buying, I do a lot of videos on the channel. Like, you look at my buy watch list, look at this video, I spent $32,000 on the stock, 6 stocks I just bought, $45,000. What am I buying, right? I'm buying dividend stocks. I'm beating Wall Street to the punch. That's what I'm doing, right? I always kind of got to think about, like, how do I beat them to the next opportunity before they see it? So in 2022, for instance, that was tech stocks. So I beat Wall Street to that, right? I was buying Meta, I was buying Palantir, and I even bought Netflix for a while. I never thought I would own Netflix, I even bought that. That went down to like 170 or 185 or something like that, right? Shopify, buying all those sorts of stocks. I beat Wall Street to the punch there. And then what happened? 2023 came along, and next thing you know, Wall Street wants to own tech stocks again, right? And they start buying those stocks up left and right. And then that continued through, obviously, into this year, 2024. So you got to beat Wall Street to the punch. I knew they were going to come back to those tech stocks. They love those tech stocks. Are you kidding me? They're addicted to those tech stocks. They're addicted to owning nvidia and Meta. You think they don't want to own those? No, there was just a short-term sellout, and then they came flooding right back to those babies, right? You know what Wall Street also loves to own? And there's a huge segment of those investors. They love to own dividend stocks. They're going to come back in droves over this next couple of years to those stocks. And it's going to be more and more and more. And you're going to go from those stocks having just immense selling pressure on them for 2 to 3 years to immense buying pressure on them for 2 to 3 years. And keep in mind, when it comes to these stocks, it's not like investors are going to be looking to get out anytime soon. Because you got to keep in mind who's buying value and dividend stocks. They're usually much longer term in nature investors. The only way you really get those folks out of those sorts of stocks is what? Take away, go have 5% plus from the government guaranteed, and people will leave those stocks. But you start to take that away, and those investors stay with those stocks for years or sometimes even decades to go in the future. They're not looking to move the money out because they're like, I'm getting my 3%, 4% yield from that stock plus share price appreciation. Why would I move out of that stock, right? So that's just a little food for thought in regards to that. And we know in terms of dividend money, that's taxed as long-term capital gains, which is a very low tax rate. So people love to own those sorts of stocks. So you're going to see a lot of buying pressure for multi-years coming into dividend stocks, right? And you see it. Like, Wynn Resorts is a perfect example. Wynn Resorts is a stock that's down 26% in the past 5 years. Is their business been doing bad in the past 5 years? Absolutely not. Obviously, it got devastated in Rona because they were forced to close their properties. But outside of that, look at their numbers. They're pretty much the best they've ever been. They're incredible, right? And so now we're going into a low rate environment, and this is going to help Wynn in multiple ways, right? One is now any debt they have, they're going to be able to pay, they're going to have much lower interest expense. It's going to help their profitability in a major way, right? And plus, people are going to be in the search for yield, and they're going to look to a stock like Wynn, who's likely going to keep up in their dividend over the next few years, and they're going to say, you know what, I need to get into a company like this. And so you'll see a multi-year move into a stock like Wynn, when really it had a multi-year sellout that was absolutely brutal for that stock to go through. A stock like Estee Lauder, all the debt on that company going to be in a much better place as yields go down and down and down, right? Less interest expense. Meanwhile, guess what? People are going to look at a stock like Estee and they're going to say, "Ooh, that's a nice dividend yield on that, and I can probably get good share price appreciation." And you'll see a move into the stock in 2025, 2026, right? Multi-year move, and next thing you know, don't be surprised if that stock's also in 150, 200 plus a share. Nike, same exact situation. Nike down almost 4% in the past 5 years. People said, "Oh, hey, I get this great yield from treasuries. Why would I want to own Nike?" Right? If I can get 5% plus on treasuries, there's no point in owning Nike. So they moved out of that stock, and it was what it was, right? But now you're going to see a multi-year move into Nike stock. Cheesecake Factory, same exact thing. Yields around 3%. Don't be surprised that dividend goes up in the future years. Stock hasn't gone anywhere for 5 years because people say, why would I want to own Cheesecake Factory stock if I can get 5% plus on treasuries, right? And you can see every single one of these stocks, right? Just relentless selling pressure, and now you're going to see relentless buying pressure on these stocks for years to come. Meanwhile, if people wanted to sell these stocks, by this point in time, they've already sold, man. I'm just going to be honest with you guys. If people want to sell Wynn and Estee and Nike and Cheesecake Factory, they already sold for the last several years, right? And so it's no different than I talk about PayPal a lot, right? PayPal, people sold that stock heavily for how many years in a row? Like 3 years plus in a row, people sold relentlessly. PayPal, sell, right? And eventually you just run out of sellers. And people are just like, there's no one left really over there to sell in any substantial way. Meanwhile, as the story gets better for a company like a PayPal, you get more and more buying pressure to come in, right? And that's how you get that share price to go up and up and up. Lack of sellers, more buyers, right? More buying pressure, boop, 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 and the share price goes up and up and up. It works in the inverse when things are going bad, and that's what's happened in these stocks for the last several years. So that's a little food for thought in regards to that. Now, as far as some hedges I'm looking at out there, I'm actually really interested in Toll Brothers. Now, here's the thing. Okay, almost all these home builders are at all-time highs right now. And the reason being is the Federal Reserve's cutting rates. So there's this assumption, right, that because the Fed's cutting rates, mortgage rates are going to go down a bunch, and there's going to be this huge pent-up home buyer demand, and it's going to bode extremely well for all these home builders, right? And that's the assumption. But as we know in the market, many times things work the inverse way people think it should work practically, right? These home builders have had the most, I would say that the best advantages you could ever imagine. Inventory was insanely low for the last several years in regards to the housing market, and that was phenomenal for all these home builders, right? Additionally, they did all these 1 year, 2 year incentives where you had a much lower interest rate if you signed a contract and those sorts of things. That helped those home builders out a lot, right? Both those advantages are slowly starting to go away. And what I'm starting to see in regards to somebody like a Toll Brothers, remember, Toll Brothers is really focused on their average selling price is like over $1 million. So that's where they're really focused, right? And I'm personally seeing $1 million plus inventory pile up now at this point in time. Like the amount of inventory that's just come on the market in the last, I would say 30 to 60 days, I'm seeing a lot. Okay, seeing a lot of inventory pile up on that $1 million plus bracket, which is not good news for Toll Brothers. In my community, I live here in Vegas, right? The homes are priced between about 2.5 million and 3.5 million. As of right now, we're sitting at an all-time high amount of homes on the market in my community, right? That's something I look at and say, oh man, that's great news for Toll Brothers. That's something I look at and I say, that's competition for Toll Brothers. No, people have all these different homes to pick from in my community, or they could pick from that other community. And keep in mind, if there's an all-time high in regards to homes, guess what? It's, people that are selling the homes aren't that dumb. They're going to eventually look out and they're going to say, oh man, I got to get competitive. And so if you do get somebody that's trying to buy your home, they could throw a lowball offer, and you might have to actually consider that lowball offer. You might not get another offer for 3 months, 6 months, 12 months, 18 months down the road, right? And so this is not a good thing for Toll Brothers. And at the end of the day, I'm looking and I'm saying prices must come down. The inventory is hitting too high on a lot of these homes. I was even looking at, last night I was messing around looking at even like Newport Coast. Newport Coast, one of the richest areas literally in the world. Like Newport Coast, insanely rich. Cheap home in Newport Coast, 5 million plus, okay? Cheap home in Newport Coast, still like 10 million. So I was looking at homes all the way 5 to 20 mil. Man, it's starting to pile up even in Newport Coast, which is one of the richest areas literally in the entire world. And I was looking and I was looking at how many homes have been on the market now, 6 months, a year, more than a year. And I'm like, dang, it's a pretty long list, right? It doesn't bode well for somebody like Toll Brothers or for the high-end housing market. And so this is something I'm looking out there and I'm like, I don't know if it's going to be as great as a lot of people are assuming for these home builders. Everybody's on the assumption that this is like going to be boom times for the home builders for the next several years. And I'm looking and I'm like, I don't know. Like I'm seeing inventory pile up here, and that's not good. What happens if it keeps piling up for the next, few months? I don't think that's going to bode very well for Toll Brothers sales numbers come 2025. If next thing you know, your price is going down, and you have inventory piling up, all of a sudden Toll Brothers has real competition in the market again. That's not going to be good for them, right? That's going to be poor for their sales numbers in 2025, which then starts to hit your numbers in 2026 and 2027, because we know there's a lag time. Because Toll Brothers numbers have been pretty decent in regards to their sale numbers, right? For the past, I would say, year, they've been pretty decent. If that falls off next year, the revenue is still going to look great because those homes are going to be delivered next year, right? But then your numbers are going to be weak for 26, 27, which then you get a big sell out of the stock. The issue I have with Toll Brothers is the put options are so expensive on this stock. Incredibly expensive. Like I was looking at like 150 strikes. I got to pay $20 for those that are less than a year out. I'm like, so now I need 130 to break even. I need 110 to double up my money. I don't love the risk reward there, right? So I think there's some other folks out there that maybe on the DL are seeing things the way I'm seeing them, and they're bidding up those put options big time. So I'm like, $20 is a pretty substantial number, right? Wingstop, this is another one I'm looking at right now. This has been an incredibly hot stock, up 313% over the past 5 years, and a lot of that, honestly, has come really just in the past 2 years in regards to this stock. Wingstop, this is a difficult one for me because, one, I don't think Wingstop's very good quality. It's like very okay quality. I don't think Wingstop's like anything special. And their forward P is 121 in the stock. Their 2-year forward P is like 90. So they basically need, the way I would look at this, they basically need a 4x or 5x their revenue and earnings per share over the coming years to eventually make this valuation make sense, right? The price to sales ratios on the stock is just ridiculous. It's like 20 plus. It's laughable. But there's always a great saying in regards to hedging or shorting stocks. You can't just rely on valuation. Wingstop's valuation, silly. There's got to be something more to the story for Wingstop. Maybe growth rates are much slower. I got to find something else before I can make a hedge on Wingstop and bet against that stock to make me say, you know what? So I got to find something. There's got to be something I find on Wingstop. But if I can find another thing on Wingstop other than just a silly valuation, I'll probably buy some puts on this one, and I think that could be a great opportunity because I think there's a chance that the market cap could go down to $5 to $7 billion type range, right? Now, you need to load the boat on value and dividend stocks that are proven that they can get through a recession. So it's going to be very important in regards to value and dividend stocks you do buy, because I think there still is recession risk out there. A lot of people are debating, have we had the soft landing? I wouldn't say we've had the landing yet. We need to see how this next year, because now we're going into the cut cycle, right? What happens over this next year? If over the next year we don't have any sort of major recession, if unemployment rate stays under a 5 or a 5.5% number, I think we can call this a soft landing, right? But if all of a sudden, next thing you know, 6 months from now, 12 months from now, we see unemployment go to 5%, 6%, 7%, well, then we never had the soft landing. It wasn't landed, right? We had the hard landing after all. So there is still recession risk out there. So you want to, if you're buying these value and dividend stocks, you want to buy the ones that have proven they can get through a recession. The reason being is then you're going to feel comfortable holding those stocks, right, and maybe even buying more during the recession. They're going to get through to the other side, right? Additionally, you get to receive all that dividend money while the recession's going on. Stocks are crashing, right? And we know tech stocks usually get hit the hardest, which means then you can use that dividend money to go ahead and buy tech stocks at that particular time, which would be absolutely beautiful, right? Now, if there's no recession, then you'll likely get sweet share gains, right? And you're likely going to receive a bunch of dividend money as well. And keep in mind, a lot of these dividend stocks are going to be upping their dividend quite a bit over the next couple of years, because basically their profitability is going to go up a lot because their interest expense is going to go down. Meanwhile, if their business is getting in a better and better place when it comes to profitability, that's going to be phenomenal, which means their dividend amount is going to increase. So you might buy a stock at a 2% yield today, right? Let's say 2.5%. You buy a dividend stock at a 2.5% dividend yield today. But let's say the company gets a lot more profitable over the next couple of years. They might up that dividend. And so on your shares, next thing you know, you might be commanding like a 3% yield on your shares, or 3.5% or 4%, right? There's always a famous, kind of look at Warren Buffett and his Coca-Cola position that he bought back in the 80s. And I believe on some of the Coca-Cola shares he bought back in the 1980s, I believe he's receiving over a 100% dividend each year from those Coca-Cola shares because of what he bought at, essentially, versus what the dividend payment, I believe the dividend payment today on a lot of those shares is more than the share price he paid for the entire shares of the company, which is insane. That means he's getting over 100% dividend yield, right? So that's something to kind of keep in mind there, and that's the way I would think about that, right? Tech is not the big opportunity now that we're going in this rate cut cycle, in my opinion. And when I say it's not the big opportunity, it doesn't mean there's not money to be made there. I think there's money to be made there. I think there's money to be made in Amazon, in Meta, in several of these other stocks, right? Shopify. But I don't look at it as the big opportunity. The big opportunity is in those value and dividend stocks because of how well those set up. And if we do go into the recession, those stocks just hold up much better than the tech stocks, right? So if we are in an upside market, I think those ones are going to see more upside than tech stocks. If we see a downside market, I think those ones are going to fall much less than, let's say, tech stocks. Tech always gets hit the hardest when you're in a recession, right? So the big opportunity right now is not in tech, right? When tech was in a big opportunity in 2022, and I do believe big tech in general could emerge as a big opportunity again in, let's say, 2026 or 2027, if a big recession hits, right? Let's say a recession hits, market goes down, S&P goes down 25, 30, 35%, 40%, whatever, 50%, okay? Some crazy market crash, right? 25 to 50%, let's call it. Then I think tech stocks would then emerge in 2026 or 2027 as the big buy at that particular time, because those stocks would be beaten down nasty style, right? But for now, I think there's money to be made there, but I just don't think that's the most money to be made there, right? Now, a lot of people scare me because I see a lot of people and they're kind of like, I'll learn the stock market more. I'll take this stuff more serious. I'll do it in the next crash, right? And I see a lot of that sort of like commentary out there. Like people aren't in that big of a rush to get rolling in the stock market, really learn what you got to learn. It scares the crap out of me because I'm like, this has got to be the silliest way of ever viewing things. When you're thinking about like, oh, I'll learn the next crash. That's like me saying like, I want to play basketball. And I'll learn to play basketball when it's time for the first game. Like what? Like, no, I should probably be practicing basketball before I get to the game, right? Like to learn the stock market when you're in the crash is just silly. You're going to make a bunch of mistakes. You're going to cost yourself so much money. You're going to be buying dumb stocks likely, like I was doing in 2008, 2009 when I first got in the stock market. When I first got in the stock market 2008, 2009 into 2010, the stocks I was buying was so dumb. I was buying Walmart, Kimberly-Clark, Conagra Foods. And those stocks, they made a little bit of money over the next year or two, but it was a very small amount. Why was I buying those sorts of stocks? Because everybody was talking about we're in a recession, so you want to buy recession-proof businesses, right? Like, well, no, you should have positioned into those sorts of stocks before the recession hit. When you're in the recession, you want to take advantage of other opportunities out there. And so there were stocks out there like Cabela's that fell to $5 in the recession. There were stocks like Cirrus Logic that fell to $5 in the great financial crisis. Those are stocks I should have been buying. Those were the big opportunities. Walmart, Conagra Foods, Kimberly-Clark, those stocks hardly made me any money. Meanwhile, those other opportunities, and you saw a stock like Cirrus Logic go from 5 to 30 very quick coming out of that great financial crisis. Saw a stock like Cabela's go from 5 to 20, right? And I got on the Cabela's train at around 20, and I rode that up to the 60s and the 70s. But at the end of the day, like I would have loved to be on that ride from 5 to 20, but I didn't really know where to look in that sort of market. I didn't have anybody to teach me, right? So I was like, I don't know. And this is what happens to people. They think that, I'll wait till the market crashes or something like that. And the other food for thought in regards to this is you're going to miss out on all the money to be made between now and whenever the next crash is. So whether the next crash is 6 months from now or 6 years from now, right? There's going to be so much money to be made in that in-between time. Never mind when we actually get the crash and you know what you're doing, that time period is going to be one of the best money-making time periods you'll ever go through in terms of on the buy side, because then coming out of that, the amount of money to be made is just ridiculous. Never mind if you know how to hedge properly, then when the crash is occurring, your hedges are going to be printing money. You'll be able to take that money and go ahead and buy stocks that are phenomenal opportunities. So you got to learn all this stuff now, man. Like, don't wait until the stuff breaks and the stuff hits the fan, as they say, because by that time, it's going to be way too late. You're going to miss probably making out a bunch of money, and then you're not going to know what the heck to do, where to look, and you're going to be like, that's going to be ugly. But a lot of people fall in that category. Don't fall in that category, okay? If you want to learn everything you need to learn about this market, how to value companies, financial statements, all these sorts of things, how to hedge portfolios, you want to enjoy an investor community that's, one of none out there, 6- and 7-figure community in the Discord chat, all those sorts of things, get exclusive content from me. Apply to join us. There'll be pinned comment down there. You can click on that, fill out an application. We'll see if we can get you access to that and take you up to a much higher level than where you're at right now, because I'm telling you, there's going to be a lot of money to be made over this next year or two, and there's going to be a lot of money to be made in that next crash, and if you don't know what the heck you're doing, you're going to miss out. That's all I'm going to say about that. Much love and have a great day.